This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 10th. Some highlights from today's show. Fed's cook is cleared for now. The Supreme Court is going to fast-track tariffs, and US PPI data is now in focus. Good day traders and welcome. It's Wednesday. Happy Wednesday. A number of things to talk about. So let's get stuck straight away and talk about our first topic of today. And that's very much about what's going on in the United States relative to ultimately Europe. So what we can see over the course of the very first 10 days of this month is right now we are seeing outperformance by the US again. Now this is interesting because for most of the first half of this year it was Europe that was very much outperforming the rest of the world. That did switch around over the course of the last 2-3 months, particularly just as we started to see the tech sort of reignite its rally once those, the tariff situation had cleared. Now, very interestingly, we did see a report out of Goldman Sachs talking about German GDP expectations for next year, given all the fiscal stimulus coming down the pipeline. And they're talking about a rebound in growth up to 1.7%. Now, why does that matter, perhaps? Well, keep in mind that Germany has registered a recession for the last 2 years, and they're likely to have another recessionary type growth pattern for this year. Point being, a lot of fiscal spending, obviously on military and defense in Europe is taking place, and that is set to drive a lot of growth in Europe over the course of the next 6 to 12 to 18 months. Now, what that means is if we are seeing a slowdown in the US, if we are going to see, as tariffs suggest and as the report that I showed you 2 days ago suggests, if we are going to see a downgrade of long-term growth expectations in the US from around 2% down to 1.5% or perhaps lower, it does start to open up this idea of outperformance in Europe. In other words, maybe we start to then see more allocation taking place in Europe versus the US. Now, we saw a little bit of that reallocation at the start of this year when the German government came out and said they're going to release the fiscal debt brake, and the result was we did see quite a dramatic outperformance by Europe. So just keep an eye. I think it's one of those trends you want to focus on. It's not something as a day trader you can look and go, well, I'm going to buy DAX today because the German government's spending. No, this is very much a trend of Europe outperforming the US. And don't forget, the flows going towards the US relative to Europe are significant. Okay, so even if a small amount of those flows start to flow towards Europe because the US is slowing down, they can be very, very dramatic. Okay, so in terms of what's going on this month, we can see the US has sort of taken that mantle again. Of course, there's a few things going on in Europe with regards to the French elections, or at least the new prime minister that was announced yesterday. So there's a little bit of instability, but it's not something that ultimately is going to change the course of the trend, which is Europe is likely to outperform the US in terms of growth expectations moving forward. Okay. Now, in terms of some of the news, we did find out about Cook. She's safe for now, ultimately. This will be challenged in the US by the Supreme... Well, the administration will challenge the ruling in the Supreme Court. So it's not that this is going to go away. It's just that the initial ruling is in favor of Cook and she is safe. Now, this isn't news. It's not market moving because the market wasn't expecting her to get fired. Okay, we spoke about those probabilities on Monday. It was around a 10-15% chance that she gets fired. So again, it's just a case of it was confirmed that she didn't really do anything wrong. And that is now clear for now. Okay. Keep in mind, of course, we do have the DOJ that is obviously conducting their own criminal investigation. So we may find out about that in the course of the next couple of weeks and months. Okay. The point being, if you hear headlines about any Fed member that's currently on the board coming under any kind of investigation, it is just going to call into question Fed independence. Okay. And that's the key thing to take away. Then in terms of the jobs data yesterday, it did not disappoint. It was quite a significant revision. It doesn't matter how you want to cut it. And there's a number of things to take away from it ultimately. And I think Anna Wong came out and she was talking about this idea of that perhaps the US was in some form of a recession already last year. We know that there's this thing called a rolling recession, which Mike Wilson has come out and declared as being over. And it's simply just a scenario where some industries are in a recession, but others aren't. And at an aggregate level, ultimately the economy is kind of okay. Okay. The point being is that there's a whole lot of, sort of opinions out there as to what this revision means. The point is that there wasn't a great deal of jobs growth last year. Okay, does it matter? Does it not matter? Well, right now the markets tell us it doesn't matter. Does that mean the markets are right? No, perhaps not. But the point is our job as traders to make sure we always trade what's in front of us, but be aware of the fact that yes, the fundamentals do not look that rosy in the United States. Job growth is not that rosy. 4 months of very weak data, an interest rate that is still very, very elevated historically, a housing sector that's very much shut down on ice, and ultimately credit card delinquencies. They don't exactly point towards a rebound in growth. Okay, now it's not to say that the Fed doesn't come in and cut rates and that solves the problem. In Anna Wong's opinion, this is what created a rebound out of a recession. It was that 50 basis point cut that they started with in September. She believes that took the US economy out of a recession. So if that is the case, if the Fed believes that to be true and they do begin the process of now cutting rates quite aggressively over the next couple of months, then yes, maybe we do start to see an acceleration in growth in the US, and maybe we continue to see this rally in the risk markets. Okay, what I do want to stress, however, the probability of a recession has gone up. Now, what is your starting point? Is it 5%? Is it 50%? Some institutional banks have it at 40%, and big banks, okay? So it's perhaps gone up slightly as a result of this data. Now, the only thing that should be true in a scenario where the odds of a recession have gone up is volatility, or the pricing of vol should be higher, okay? Right now, the markets are not pricing volatility, which suggests that the markets aren't pricing risks correctly. Does that mean the markets are right? Does it mean they're wrong? Well, at the end of the day, if everyone thinks that the Fed's just going to come in and support the market and there's no need to hedge those risks right now, well then the market is correctly priced. Okay, but what I do want to stress, anything can change at any moment, and if there's one thing that is true, if the odds of a recession need to be repriced, volatility will be repriced significantly higher. Okay, right now it's not there. And that's why what you need to post up in front of you every morning is, what is that volatility doing? What is implied vol doing? Because once it starts to move, okay, it is very much something that's going to pick up speed. It's not something that's just going to keep getting faded. We know for the last couple of years, the vol fade trade has been a very popular trade, but if they are starting to price risk correctly as a result of recession odds rising, it's not going to be a very good time to fade vol. Okay, so keep an eye on that. It is a chart that you've got to look at every day, because at some point it will matter, and at some point it's going to make you a lot of money. Okay, if we then move on, of course, talk a little bit about the tariff situation. The Supreme Court has given the Trump administration some form of a timeline now. It's going to be around November. That's when they're going to start hearing the case. So we know that the Supreme Court has agreed to keep the tariffs in place. So everything stays as is until at least November. And then we'll start to get some understanding of what comes next. Okay, I think this is very much on ice for now. And like I said on Monday, it just creates a lot of uncertainty. Okay, if you're a big business right now, fine, you're going to pay some part of the tariffs because you have to give your consumers something. But right now, you're not making any big decisions because it doesn't make sense. Okay, everyone is going to be waiting for November. And like I said, if the economy is slowing, if jobs growth is slowing, none of this uncertainty is going to aid a rebound. Okay, you've got to put two and two together. Use your brain. Okay, none of this is going to be net positive for the economy. So the longer this goes on, the longer this gets kicked into the future, the greater the odds of that recession is. Now, it's not to say we're in a recession or we will go into a recession, but the odds of a recession change. Okay, and if the odds change, vol needs to be pricing accordingly. Okay. Now, in terms of the US stock indices, we had a nice record close. Dow closed at record high, S&P at record high, NASDAQ not quite there yet, Russell not quite there yet. But again, the key takeaway from that is, with all this uncertainty, with that non-farm payrolls revision, with the really bad non-farms on Friday, stock markets are closing at record highs. Do not discount price action. The markets clearly are discounting bad data. They do not see it as a bad thing. They're taking the glass half full, and that means you cannot sit there trying to sell this. You cannot sit there just because we're in a recession and you think that's the right trade. You're going to get run over. The time to sell is the time when everyone else starts selling. That's how this works. Wait for that VIX to start to move up higher. At that point, by all means, join the parade. Okay? Until then, price action is very much bullish in the near term. And I think that matters a great deal because we've got PPI today, we've got CPI tomorrow, and I'm reading a lot about how PPI can derail it all. It can all be bad. The reality is we had one of the highest PPI beats last month that I've ever seen in my entire career, and the markets retraced the entire move. Okay, the point is that data that goes against the consensus, which is for higher price in the stock market, just simply is being retraced. Okay, it just doesn't matter today. Doesn't mean it can't matter at some point, but right now the markets are shrugging it off. Okay, in terms of then some of the expectations, there you can see the previous PPI, sort of numbers that came out, as well as the forecast for today. We'll get to that chart in a moment. Just be aware we have got key data out in around half an hour's time. Okay, and then don't forget ECB tomorrow. Now, in terms of some of the key charts, US 2-year, we spoke about this yesterday. We spoke about this pretty blue line called 355 in the 2-year. We know this is an important reference point. We know that the markets respected it. It's not closed above there. Keep an eye on this. Okay, watch how we close today. Watch how we close relative to the PPI print. Should the PPI print, of course, miss, don't be surprised to see us move back down towards the lower end of that range. But the rates markets are now going to wait and be very data dependent. Okay, it's very much a case, should PPI miss the expectations? Absolutely, we'll be trading 350. Should they beat the expectations? Well, does it really matter? Is it going to stop the Fed from ultimately cutting next month? Absolutely not. Okay, the Fed is cutting next month regardless of what PPI and CPI does. They will take that insurance now. It's more a case of will they take 25 or 50 basis points insurance. Okay, so on that note, keep in mind, should you have a big miss in PPI today, all right, what that does is it gives the Fed a big opportunity to ultimately come out and take bigger insurance, i.e. 50 basis. Okay, and that's how you have to think about the CPI for today. Now, in terms of the dollar, this is an interesting one. This is a head scratcher. The consensus here is everyone is short. Now, what I do want to point out, I was talking about this morning, the Swiss franc to date, year to date, is up 14% against the United States dollar. Okay. Gold at record highs. The fact that gold's up 40% this year and the Swiss franc against the dollar is up 14% really tells you there are some significant shift in flows in the global economy. Okay, none of this points towards a risk positive environment, and yet equities are at record highs. The point being is that you can have these macro playbooks and they will resolve and be true at some point, but right now the markets are very much bullish, despite the fact that everything points towards them perhaps not being so bullish. Okay. What I want to point out in terms of the dollar is it is 4 weeks of unchanged price activity. Now, what typically happens here, and I think it's one of the things you've got to be very, very switched on for, is that the sort of the lack of momentum here does worry me a little bit. I would have thought by now the dollar would have continued that move lower, perhaps made another lower low, or sort of done something by now, given the weak non-farms data, given the data deterioration in general. And yet the dollar is holding up very, very well for the last 5 weeks. Now, what that suggests to me is the market's lost its momentum. It suggests to me that shorts of the dollar are perhaps a little bit vulnerable. I was scratching my head on Friday and Monday thinking, why the hell is the euro not able to sustain a bid? And I suspect it's just there's that real lack of intention now from being too short the dollar at this point in time. Okay, so what that all points to, a market that's very, very short, that cannot go down, that kind of even doesn't go down on data that should make it go down, does really point to perhaps a scenario where we could see a little bit of a dollar squeeze in the near term. Okay, keep an eye. Where do you want to take those bets? Well, I think short pound is not a bad shout. I think that's definitely somewhere you could get some good upside, as well as some of the other sort of markets in the currency space. Okay, keep an eye on that. I think the dollar is very much in play in the near term, particularly around some of these data points. And there it is. Okay, there's the VIX. I think it's a key chart. It massively matters as we go into PPI today. I just want to reference that Friday VIX. Okay, really bad print, like a shocker, and yet what has that VIX done? Okay, it just retraced, got slammed straight back down the page. It really does point towards a scenario in which I suspect that VIX is now going to go make a new yearly low. And if that is the case, with stock markets at record highs, guess what? Okay, the sky is blue. There is absolutely no reason to go down. If the bad data cannot take the stock market down, very little in the way will actually take the market down. Right now, it's very much into the roll week. It's very much moving into that OPEX next week. So it does feel like a scenario in which once PPI clears today, should that come in line, I think we make new record highs. Should CPI come in line or even miss tomorrow, all of that just points to more record highs over the course of the next week. So not a time to fade it. Price action's anything but bullish. Okay, sorry, anything but bearish. Right now, it's very much blue skies to the upside for the equity markets. And the VIX, again, we take out that non-farms low. I think that's going to be a good confirmation. We get back below 15. I think you do just have to be brave and ultimately get long those equities for a continuation of these moves to the upside. Okay, and then finally there is the PPI chart. There was the significant beat. It was a 0.9 change, or month over month, which is significant. I mean, when last did we have 0.9? Back in COVID. Okay, so my point is that it was a significant beat on the PPI. Everyone was waiting for it. It was pointed that the tariffs are finally starting to filter through. Did the market care? Well, it cared for about an hour, and then it retraced the entire thing. Okay, the point is that yes, it does matter at face value. It's not that it doesn't matter, it's just it doesn't matter for the stock market. Okay, so we have to have that same sort of mindset, that same viewpoint today. A beat, fine, there'll be a little bit of noise, there'll be a bit of vol, but watch that vol get squashed. If it does get squashed, we're going back up to record highs, and therein is ultimately, I think, the best play for today. Is some sort of a beat. Don't be surprised to see that market fade, and then of course make new record highs. Okay, on the other side, should we miss? Okay, the expectation is for a 0.3 print on both the core and the headline. Should we miss a 0.2 or 0.1? Well, that really does call into question the pass-through effect of tariffs. Perhaps we start to see a narrative that tariffs are not as inflationary as everyone expected. Perhaps we start to see a narrative that demand destruction is taking place and consumers are buying less. Therefore, prices are not quite input prices and at the factory level are not quite as high as expected. The point being is that a miss ultimately is going to just raise the odds of a 50 basis point cut. Okay, music to the equity markets ears. Of course, we know the dollar is poised to do something, and we know that the bonds right now, particularly the front end of the curve, are looking to push a little bit lower in terms of yield. Okay, so there's a number of things going on, but I think the key takeaway for today is that PPI is important, it does matter, but perhaps it's going to be a bit more about the technicals, a bit more about what the price action suggests, which is we do have a very bullish environment today and into the OPEX next week. Okay, with that in mind, there's a lot to digest there. We have got now just 20 minutes to that PPI data, so it is very much a case of good luck out there, manage at risk, go make some money.